Hey, good morning and welcome to the Money and Finance for Expats podcast. We're slightly late starting this morning. Had a few technological difficulties, but we're fine now. We're absolutely fine now. How are you this morning, Paul?
Yeah, it's been a good morning.
Good. Good. Yeah.
Besides the 15 minutes struggling with tech.
I think you're back
Uh,
in your mindfulness zone now, though, for the podcast. How about you, Matt?
Yeah, good as well. Apart from operating as Paul's IT expert, and I'm definitely not an IT expert. It's been a good morning. So yeah, we're all
Seamless,
good here.
seamless. We're
Yeah.
all here now, and this morning, of course, we will update you on the global financial picture, which will come from Paul, and then we'll switch to Matt to talk about swapping the living in the UK for the Iberian Peninsula, with a particular emphasis this morning on what to do when exiting the UK. So we have some fancy graphs again. That was excellent last week, Paul, for the whole year picture. But we're looking more specifically, aren't we, in the times we're living in, those continually interesting times that we're living in right now. Would you like your first graph?
yeah, the first graph is the EU economic sentiment indicator. Unfortunately, the graph, Carl, doesn't appear to be up to date with the latest data that came in on on Monday, I think it was.
Okay.
But basically, what the index reflects is the optimism or pessimism of business managers and households about economic conditions. And the reading came in marginally lower than in December at 87.40. You'll see the graph, it says 99.9, but I don't think that figure is correct. It came in, as I said, slightly lower than expected at 87.40 and considerably lower than a year ago when it had peaked at, I think it was 107.80, which was around, I guess, just about here.
Okay.
Um, if I can just show it with my just okay. So yeah, I think it reflects the fact that economic conditions are perhaps um, not as good as they were a year ago, entirely consistent with what we would expect with further tightening of monetary policy.
Okay. Should we have a look at the manufacturing now as well? That does, on first glance, that doesn't look too healthy.
I think the second one is, well, manufacturing. Yeah, it's fine. Yes, the second index is the EU industrial sentiment indicator, and the index measures the confidence level among manufacturers in the EU.
Mhm.
The reading came out much better than expected, so that was a surprise. It came in at 1.3, as it shows on the rightly shows on the graph, compared to last month, which was negative 1.5. So I think the only rational conclusion to draw from that graph is that um, sentiment has worsened much less than feared, and that's partly due to companies strengthening their cash reserves.
Okay. All right. And we can go. We'll
So
be
on the
looking.
manufacturing activity, it would seem that at least in the EU, we may have bottomed and the outlook's starting to look a bit better. Perhaps they're already anticipating further, or rather pricing in the rate increases that we're going to get in the first half of 2023, but companies generally are cash rich and in a good position to endure any tightening of financial conditions.
Okay, well, I'm hearing some positivity. Let's stay in the EU and with Germany, and a couple of graphs from relating to German statistics here, GDP. What's happening here, Paul?
Well, it's important to focus on Germany because it's the locomotive of the entire European Union as the largest economy and a driver of economic activity. So focusing on Germany gives us a clue of what's happening across the entire European Union. The figures came out again on Monday for fourth quarter and for the whole 2022, and for Q4, which was ending, last quarter of 2022. Economic, excuse me, economic activity declined by 0.1%. So at least for that quarter, you could reasonably argue that the German economy was entering into recession. And for the whole 2022, the annual growth was anemic at 1.1%.
Yeah. Okay.
So clearly, I think if you look through this graph, you see that the economy is slowing down um, considerably, and I think it would be reasonable to assume that as we enter into 2023, we might have another negative quarter in Q1 and possibly in Q2.
Okay. Let's
So
stay with
yeah,
Germany then. Staying with
that
Germany
that,
here.
that is German, and this is the I presume this is the year-on-year figure. It says 1.9, and it's actually lower than that. But anyway, because sometimes Bloomberg might not pick up the might not pick up the first. Anyway, it should read 1.1.
Okay.
But yeah, it's as you can see, in the past, economic cycles used to be
Definitely.
clearer, 7 years of growth and 7 years of decline. But with the new firepower the central banks have, which is called money printing, cycles tend to be shorter.
Mm.
And as you can see, there's no logic to the graph. Yeah, it's just up and down.
Staying with the analogies then, and you were saying the patient is somewhat anemic. Money printing is what, like having an adrenaline shot, is it? We're talking medically.
Medically, I like that analogy. I think money printing is like it taking the patient and putting them on life support permanently,
Yes.
and saying that the patient is alive, but there's no interaction with other human beings, right? It's a
Wow.
zombie.
Zombie economy.
It's a
Wow.
zombie economy and zombie companies. Yeah,
Wowzers. Okay. We're staying with year-on-year figures and US house price index. What does this show us?
yeah. Again, I updated this. I think was at the beginning of the week. Let me explain the graph and then what we are expecting. I haven't updated it yesterday, unfortunately, so I'll try and do so next week. But this index measures on a month-to-month basis changes in average prices of single homes in of single-family homes with mortgages, which have been financed by Fannie Mae and Freddie Mac. I mean, Fannie
Right.
Mae lost a lot of credibility in the marketplace because they were the ones that gave finance during the global financial crisis and repackaged that debt, sold it off to the banks, and then they were sold off as AAA rated bonds when they were really junk.
Yep.
So discredited nonetheless, but they're still part of this index. But what it shows, or what we're expecting, is a 5% increase in um, in average house prices in 2022 in the US. Um, but I think the graph shows that it may have peaked uh, possibly a year ago,
Mm.
and when it was double digit, as you can see there. But it's clearly edging lower since about February of 2022. The interesting thing is that Zillow and Fannie Mae now expect house prices to decline in 2023 by anywhere in the region of 1 to 1.5%.
Okay.
Um, as economic conditions tighten, as interest rates peak, and then stay there possibly for the whole of 2023, I think the house prices will decline. And the important thing about including this um, US house prices in our graphs is that when house prices come down, it tends to dent consumer confidence and
Yes.
therefore discretionary consumer spend in the world's largest economy, which is mainly driven by services. So it's really, really important to keep an eye on US house prices because it has a significant impact on consumer confidence and therefore on disposable incomes and discretionary spend.
Very good. Okay, and we can see the dent, can't we, of the crash of 2008 there, and interestingly,
Exactly.
yeah, with the pandemic as well, that strengthened things, didn't it? Because I think what people consolidated, stayed at home, and realised the value of their home asset. Is that what was going on there?
Exactly. But
Yeah,
the interesting thing, the graph here is not entirely correct, and I'm pointing here. I don't know if you see
I can't see your
my
cursor, unfortunately.
okay, it should be 5. So it's
Right.
declined a lot more from there.
Yeah.
And you'll see that we will go into, sorry, much more than that, is around in line with the bit here.
Yeah.
But it's going to decline further. And
Okay.
and the question is, how far down will it go? You know, these analysts are, and Fannie Mae, of course, because they extend credit, have a finger on the pulse, and they are suggesting they will go to into negative territory marginally, may decline 1 to 1.5%, but those are just initial estimates, and no one really knows the full extent of the decline in 2023.
Yes. Okay. All right. So an interesting set of figures to look out for, especially there, the US house pricing index. Let's go back to Europe now. And what are we looking at here? You're busting through the acronyms for us. This is I've got as ECCPEMUY. What does that all mean, Paul?
God almighty.
Yes, that's what I thought.
I've got no clue. No, I think it should be, if it follows the correct order, then this is EU inflation data
Okay.
year on year, and it's a
Yeah.
preliminary figure. It actually comes out today. I think looking back um, at the data that has come prior to today's data, inflationary pressures seem to be receding.
Yes.
December's data came in at 9.2. I mean, I say this with tongue in cheek, receding, yeah, because it's almost double digit inflation.
Yes, indeed.
But it came in at 9.2 in December versus 10.1 in November, and against an all time high in October of 10.6. And if you see the graph, it kind of peaks a couple of months ago, and it's coming down very gradually from a very high level.
Yeah.
So we need to see whether inflation continues to recede on the back of tighter monetary conditions when the figures released today. I
Yes.
think, in all probability, if the US is any is a benchmark as a leading economy, and given the aggressive rate hike we've seen in Europe in the last 6 months, it's quite likely that the figure comes in a touch lower than December. So the trend seems to be confirmed. The tighter financial conditions are starting to bring inflation down from double digit. Yeah,
That's
it
what I
might take
was saying this morning. Yeah.
it might take some time, and it all depends on how long they keep those rates up.
Yeah.
Um,
Talking about that in Portugal this morning, it's a direct reflection of that. And of course, from a glass half full point of view, that is, it's coming down. But for a glass half empty, it's still way too high, right? Depending on which
oh,
which way you frame those statistics.
exactly. I mean,
Right.
interestingly, if you look at the period of the pandemic, and it's a shame that you can't see my arrow pointing,
Yes.
because the readers would benefit from that. But it kind of inflation was almost zero
Yeah.
as we entered the pandemic. Yeah, in June 2020, you can see it there.
Yeah, for sure.
Even deflation, arguably, we went into deflation for a
Yes.
period of time from June 20 to December 20. And then, of course, as we unlocked, and the vast amount of monetary or printing of money started to find its way through the economy, then inflation, as you would expect, too much money chasing too few goods. Any
Yes.
good economist will tell you that leads to inflation. And that's what we
Okay.
saw.
Where do we find one of those? Anyway, maybe that's not the question for today. Where do you find a good economist?
And yeah, you had this Austrian economic guru who said that you could print as much as you wanted and had no inflationary implications. Is that
Yes.
not correct? Didn't
We
you have a
we
guess?
do hear these sentiments expressed from
Didn't you
time
have
to
a
time.
guess that said that you
We
could
did.
have print as much as you can, and there's no inflation. Or
Well,
am I
this
wrong?
this is the old sort of cliche, really, isn't it? Of a
Yeah,
global economy or national economies are not the same as household economies, and that's your monetary theorists. I think that's what they're called. Will say, there's nothing wrong with printing money and keeping an economy going that way. And then there are other people, mostly most of the rest of people, I think, who think the analogy of the household is a fair one. Yeah, I think you do.
absolutely.
Right, okay, let's go look at the Federal Reserve then. Now,
Federal Reserve.
what's happening here?
Again, I mean, we expect the decision to be made by the US Federal Reserve later today. So, very key decision. I think the Federal Reserve in December raised rates by 50 basis points to 4.5. That was the last monetary policy meeting of 2022. As you can see, historically, although there have been periods in the 70s when the Federal Reserve have raised rates much more aggressively than in this instance. I mean, if you look at the pattern of history and the Federal Reserve and interest rates, this is they have never raised interest rates so quickly as they've done this time around. You'll see the rate hikes from 0 to 4.5 or 4.25 in 10 months.
Mhm.
So it's been very aggressive and the fastest time in history that they've gone from 0 to 4.5. What do we expect today? Um, well, they've pushed borrowing costs to the highest level since 2007, pre global financial crisis. Um, so, what is the general consensus? I think everyone is pricing in that the Federal Reserve will raise rates by another 25 basis points to 4.75. Anything greater than that will send shockwaves through the entire financial system
Mhm.
because no one is expecting more than a 25 basis point rate hike. And there could be a further um, rate increase of the quarter thereafter. Interest rates, I mean, most analysts will now claim that the terminal rate, the maximum rate, should be around 5, but one never really knows for sure. I
Mhm.
think after they increase rates twice in at the beginning of 2023, we'll see a hiatus and a little pause. And then the question is, how soon does the Federal Reserve pivot and start injecting um, liquidity into the system and cutting rates back? And that is the $1 million question. No one really knows. But as I said, if there's no rate increase, the market will rally. I doubt that very much. If it's an increase of 25 basis points, it's fully priced in by the market. Anything more than 25 basis points will send shockwaves, and stock markets will decline quite a lot.
Well, and that's today, is it? Those figures will be
That
released.
is today, so everyone should keep their eyes firmly on the screen this afternoon.
Okay. Is there anything from the Bank of England which we're going to
Yeah,
now? Uh, okay. Do they announce at the same time, or how do we keep an eye on what's going on here with the Bank of England?
I think the Bank of England actually announced it. No, it's on the 2nd.
Okay. All right.
So it's tomorrow. The Bank of England is tomorrow, and so is the ECB EU, and
Yeah.
they tend to give themselves a day and then follow like sheep. Yeah,
Yes.
unfortunately, but they pretend that they have this monetary policy committee setting interest rates, but someone whispers in their ear what they need to do. But anyway, that's my personal view,
Yes.
right
Okay.
or wrong.
All right.
But the Bank of England Monetary Policy Committee voted by a majority of 6 to 3 to raise interest rates by 50 basis points to 3.5 during its December meeting, and pushing the rate of borrowing again to the highest levels since 2008. Interestingly, at the last Monetary Policy Committee meeting, two members voted to keep rates unchanged. Not enough to sway the majority, but enough to show that there's discontent in that committee. Not everyone is advocating for such aggressive rate hikes. Some want to take a more calm and measured approach. But with double-digit inflation, with tight labor market conditions, with high wage growth, as we know. There's the unions and the NHS, and
Mm,
everyone is demanding a salary raise to keep up with inflation. So persistent inflationary pressures are likely to result in further tightening. So I wouldn't be surprised, because remember, the Bank of England is behind the curve compared to the Federal Reserve. And I think the market is pricing in 50 basis points to fall. So
okay.
again, eyes on the screen. Let's see what happens tomorrow, whether it's 50 basis points or not.
And that's against the background of terrible economic performance as well, isn't it? That
Oh,
was released
terrible economic.
the last
Exactly.
4 hours.
This is the how do you call it? Um, this is like one last dagger, yeah, to the
Right.
heart of the economy, because the economy is pretty fragile in the UK,
Yes.
and higher rates are going to start biting even more. I
And
think
it was an anniversary, wasn't it, of Brexit yesterday?
it
And those
was.
and those
It
figures
was.
came out as well, didn't they? Which we did not make for good reading, and pushed down the any pro Brexit person was saying again, no, you have to wait and see. You got to wait and see. And after 3 years, a pretty awful picture.
Carl, if you can try and get online,
Yeah.
because yesterday, the anniversary of 3 years, I think that we left the EU, there was an online clip or an online video of Kenneth Clark,
Hmm.
one of the conservative stalwarts
Yes.
of the Thatcher government, delivering a speech to the Houses of Parliament, saying that what a blunder to exit the EU, what a big mistake the UK was making, and then um, I think very eloquently putting the case for staying within the EU, and
Yeah.
explaining that the UK had been instrumental in bringing in Eastern European economies into the EU, because as they left the old Soviet Union, the UK thought that, for not just for economic prosperity, but to bring political stability to the region, to Europe, including Eastern economies, it was vital that these um, span off countries from the former Soviet Republic could join the EU,
Yeah.
which
Yeah.
was a masterstroke. And then they were also instrumental in developing the single market, because you know the old European community was um, all about lifting um, trade barriers, right? To
Hmm.
try and stimulate greater economic activity within the region. But the UK took it a step further and promoted the concept of the single market, which was one market, not just no trade barriers, but the same regulation, so you can operate seamlessly across the entire market. And it was the UK that drove that development. So the UK were not
Incredible.
passive backseat passengers on that EU journey. They played a pivotal role, and he this was when they were voting in favor of the referendum, because they had to. And he said he was voting with his conscience, and he outlined with no papers. He didn't look, I think he looked at his notes once,
Hmm.
and he explained himself so clearly. It was one of the most impressive deliveries I've seen at the dispatch box in
Yeah.
Parliament. And he was doing it from the backbenches as well,
And
saying
it
why
made
he
for
thought
it was an awkward clip to hear yesterday. Then.
it was more than awkward. Well, it was awkward, because he
Yeah.
was saying, all these fantasies and coming up with all the benefits of exiting, and he was advocating exactly the opposite, and why it was going to be a disaster.
Yeah.
And he isn't far off, is he?
It would
So if
appear
you
that way
can
at
try
this
and
stage. Yes, indeed, Kenneth Clark. There you go. Thank you for that. A couple more graphs. We're going to go to back to the ECB now. Uh,
again, the
yeah.
ECB is even further behind the curve than the Bank of England. Again, tomorrow, around roughly the same time, they are due to advise on their interest rate decision. I mean, inflation remains stubbornly persistent in the EU. At the last ECB meeting, I think it was December, they increased rates by 50 basis points from 2 to 2.5. You can see that on the graph. And they're expecting it to peak at about 3.5 in the first half of 2023.
Okay.
So the market is already pricing in a 50 basis points increase in rates from 2.5 to 3. That is the expectation.
Okay. All right. That's the ECB. And then finally, US unemployment. Why is this
Yeah,
important to us?
we have to wait. I mean, the US tends to release their data on Fridays. The unemployment rate, this is perhaps the outlier, and no one really comprehends why it's holding up so well, aside from the fact that the unemployment rate is a lagging indicator and looks back in time, but doesn't reflect what's going to happen uh, ahead of us. But the
Mhm.
unemployment rate in December fell from 3.7 to 3.5, surprising markets and showing incredible resilience in light of the most fast and aggressive monetary tightening in our lifetime. Um, so that did take the market by complete surprise. And the market wants to see signs that the economy, the US economy, is now slowing down in line with inflation.
Mhm.
And expectations are that the unemployment rate goes back up to 3.7, which is still at a historical low level. But let's not forget that a lot of large corporates in the US, quoted companies, have already announced major culling of their workforce. So I think you can't really read too much right now into that data, and it'll be interesting to see where we're at rather than at this moment in time, but at the end of Q1 2023.
Okay, there we go. And that's the graphs and stats and the insight from Paul Correa of Fiduciary Wealth Management. Anything else you want to add in conclusion before we take a look at exiting the UK for the Iberian Peninsula?
I think I've covered, unless there's any specific questions. I know there's a question we need to answer at the end, yeah? From
We
one
have
of
a
your.
number of pointers that have come in, and they're in the back office for you to look at. I call it the back office. I sent them to you via WhatsApp if you want to have a look. Thank you, Meta, for our back office there. Let's go to Matt then. Thank you, Matt. We're looking at exiting the UK and the things you need to consider. A lot of people will be thinking of sun cream, sunglasses, pair of shorts, and a few euros in the back pocket to enjoy the first paella and a big pint of beer in the sun. There are other considerations, are there not?
No, absolutely, and you're right, Carl. I think anyone moving across, first port of call is, get themselves to the Chiringuito or, out in the sun or whatever, the Brits like to do in Spain, Portugal and Gibraltar. But I think what we always stress is the importance of exiting the UK properly. And we mean not just in a physical sense, that's obviously important, but it's important that you go through the kind of proper processes, because I think the last thing you want is you're settled in your new home and then you've got HMRC on your back, or you may find yourself in a position where, oh, I'm living in Portugal, but why am I still paying taxes in the UK?
Yes.
You paid your taxes in the UK and you may be able to claim them back. Now, I don't know if anybody watching this has ever tried to claim money back from the tax authorities in whichever country, but good luck with that. It's going to be a long journey. So I think the main thing we and there's a lot involved and some kind of crossover with other things we talk about. I know, Paul, you wanted to mention as well that there is a difference between kind of tax residency and domicile, which are kind of two completely different things that people often either get confused between or overlook one.
No, I think it happens all the time. Every time you speak to British expats who require our help and advice in moving from the UK to somewhere in the Iberian Peninsula. And they seem to interchange the words tax residency and UK domicile. And they think that they are one and the same thing, when in fact they are completely different things. And the concept of domicile and UK domicile is completely misunderstood by exiting British nationals. And I think it's one that is worth covering and explaining what the subtle difference is.
Yeah, go
Yeah.
ahead.
No, I think the plan is, in very short, you relocate out of the UK or any country, and you move to another jurisdiction on a permanent basis. You're effectively switching your tax residency for most streams of income. But your domicile, that's in the UK, inheritance tax liability is linked into your domicile. We gain our domicile at birth, and it's you don't lose this just by relocating out. Some people think you do, but that's absolutely not the case. And I think it's something that Paul and I talk to individuals a lot. There's a lot of misunderstandings about it, and it's linked into inheritance tax, which I think there's been a lot of focus on this. I've seen in the press of late, because the UK government are taking in, receipts from inheritance taxes going up year on year because the allowance stays the same, and people's houses are worth more, people are saving more. So I think it's probably something that we will focus on more detail in an upcoming podcast, because it's something that we could talk for a long time about, and it's important. But so today we will it's more about your tax residency. So your tax residency generally is based on where are you spending the majority of your time. So as an example, in Spain, you spend more than 183 days in Spain, you're a tax resident in Spain. They do have a second qualifier, which is Spain your center of economic and vital interest? So what they mean by that is Spain your home, even if you're spending less than 183 days? So a common example we see is people say, okay, I want to be a tax resident in Gibraltar because it's got a more generous tax regime, but I want to live in Spain. And somebody rents a studio flat in Gibraltar. They maybe spend their week there in that flat, and they have their big house in Soto Grande or Marbella. Their kids go to one of the international schools there. Their wife or husband is there. In that sort of situation, Spain would look at it and say, you know what, your home is Spain. Pay your taxes, pay us now. And there's differences with that. But so when it comes to exiting the UK to become a tax resident, you should do it officially. So the main point of that is you file your P85 with HMRC. Or you can do it via your self-assessment. So if you fill in a self-assessment, you can actually note on there that you're changing your tax residency. So that's a kind of official way of doing it with HMRC, and that should help you generate what they call an NT tax code, a non-tax tax code. So tax that you shouldn't be paying in the UK, you won't be taxed at source. So you can be paid gross, save some pensions, and therefore you just pay your tax in Portugal, Spain, Gibraltar, wherever you're based. Because the danger of not doing so is you pay tax in the UK and you pay tax in Spain and Portugal. And yes, there are double taxation agreements, but it's something to be very careful of. And in reality, if you're relocating to another country, you want to be paying your taxes there, especially somewhere like Portugal, where we have the non-habitual residency scheme, or Gibraltar, which is very tax friendly as well. So it's important to do that. And we always say that people should try and leave in a cleanest way as possible. So the ideal way to do that is leave at the end of the tax year.
Oh, okay.
You finish the tax year in the UK, leave early April, and then we're finished there. Okay, I now become a tax resident in Spain, Portugal, wherever you're moving to.
Okay.
But there are ways to do it mid-year. You can. There is a concept of a split tax year in Portugal and the UK. And there's kind of three instances when this works. If you're starting a full-time work overseas, so in your new country, or if your partner or a spouse is doing so, or if your permanent home, i.e. you cease to have a UK home. So you sell your UK property, then you buy your property in Portugal, then you can use a kind of split year concept for that. But for us also, it's when you're leaving the UK, you need to kind of consider, right, what do I do with my UK assets? What do I do with my UK pensions? What do I do with my UK property? And there's a lot of important things that you need to do before you exit the UK. You know, the property is a big one. You sell your main home in the UK, there's no capital gains tax. You retain that property and say move to Spain, and then in a few years later, you want to sell that property, then Spain will be looking at you and say, right, you need to pay capital gains tax on the growth of that property. So there's a lot of kind of things like that need to be considered. Pensions is another one. In pensions, you have what they call the pension commencement lump sum. It's 25% that you can take at the outset. In the UK, most of us refer to that as a tax-free lump sum. But financial advisors outside of the UK no longer say this, because if you live in Spain or Portugal, they don't recognize it. So it's not tax-free. So if you take that lump sum while you're a Spanish or Portuguese resident, you will pay tax on that as well. So again, if you're planning your exit of the UK properly in advance, you can avoid that. And I think the last thing that I cover, and this is something Paul and I have mentioned before, and we mention every time, and not just for our benefit, but for individuals, is you may have your UK advisor and built up a relationship with them for some time. But the fact is, the UK advisor doesn't have the regulation to advise you in Europe, nor do they have the understanding to advise you in Europe. And I give a very quick example, someone I spoke to recently, Carl. So this is a gentleman, he lives in Portugal. He's lived in Portugal for some years, 4 or 5 years. And but in the UK, he had a financial advisor who still has a connection with his financial advisor. And they set up a bond for him, a UK compliant bond for him, a very large one, several million. And then I was talking to this guy, and this is something we will cover another time, but there's a Portuguese compliant bond. A Portuguese compliant bond is tax efficient in Portugal, but it's a very specific product. This guy, this individual, he spoke to this advisor in the UK, and he said, well, this UK bond, does this work the same way for me now I'm in Portugal? And this advisor said, yeah, you'll be fine. And he also said, and quite simply, it's not the case. And it's because that advisor probably didn't want to lose that business, and he didn't understand how the bond worked. So he said, it's fine, just keep the status quo. The bond is in the UK, it's compliant here, don't worry about what happens in Portugal. And what will happen is that individual will have to pay an incredibly large amount of tax that he wouldn't have had to pay if it had done things properly. And I actually went back to end the story to this UK advisor, and he said, I don't give advice in Portugal. I didn't give advice on this. I reached out to someone in Portugal, and they told me it was okay. And quite simply, the individual is not protected, because you can't claim bad advice from, I was told by somebody, a friend of a friend sort of thing. And it's like we always see what I call the Facebook effect.
Yes.
And Carl, you're probably in these, expat Facebook groups, and you see all the time people saying, oh, what do I do with this? What do I do with that? And these groups are great for certain things. Can you recommend so-and-so? Can you tell me where this is? But people are going on there asking about their taxes and their finance, and it's madness.
It's an industry problem, though, right? Because where somebody is living on their commissions and they get asked a question like that, they're going to want their commission, aren't they? And by the time the repercussions and implications are felt of their bad advice, they'll be long gone and probably have spent the commission by that stage. And you operate in a different way to that, don't you?
They're
Absolutely.
compromised. They're
Yeah.
compromised.
Yeah, yeah,
They're compromised immediately because they are driven by wanting to retain the client. Look, we understand that it's very difficult to cut the umbilical cord and to change advisors, but firstly, they're not regulated in Portugal to give that advice for the case that Matt is referring to. And secondly, they don't understand the nuances and the differences in the tax regime. So I think on the one hand, they want to retain the client relationship, but on the other, they're not qualified and they're not knowledgeable enough to give good advice to the client. Why should the client retain that advisor when it's not in their best interests? It
yeah,
is almost illogical, but
yeah.
it happens all the time.
Sure. And
All the time.
we're looking at a dynamic here, aren't we? Generally speaking, of kicking things down the road, which is what that is, of course. Deal with the implications later, or plan in advance, which is, of course, what you're talking about. Where you began here, Matt, in the checklist, basically, which I'm sure you offer to your clients. You're going to run them through a checklist of things they need to be aware of, as well as going to get the proverbial suntan lotion and sunglasses long before you leave. Go through a checklist to make sure that you're leaving cleanly, as I think you put it. And so take a step back rather than hope everything's going to be all right in the future.
Yeah,
Yeah,
absolutely. I mean, we have what we call our roadmap, which is what you should follow in sequential order. And yes, you need to get this sorted before you do this. And look, we all get very excited about relocating to the sunshine and a beautiful country, a beautiful people, and that. And I guess it's our job to say, look, okay, you may see these are the boring things, are the nuisance things, but we promise you, you get these sorted, the earlier the better. Then you can enjoy your lifestyle. Because and also you're planning while you're in the UK where you want to leave. Use your time there to get things all in line, and then
Yeah.
when you're in Spain and Portugal, everything's sorted. So then you can go to the beach or the Chiringuito or whatever you want to do.
And they will
I
affect your
think
quality of life as well, won't they? If you don't take care of those things, it could affect the quality of life you've worked so hard to create for yourself.
Yeah.
I think people get carried away with excitement, and they very often don't plan an orderly exit from the UK.
Mm,
And because they are completely focused, the energy is focused on tax efficiency in the new country of residence.
yeah.
So they ignore that part of the equation is how do you maximize the tax benefits of exiting your exiting the UK. And I'll give you one example. I mean, you need to sell your main residence, or you might want to sell your main residence to make maximum use of the capital gains tax exemptions for principal private residence relief. And those remain in place and stick around for about 9 months after you exit. So if you exit on the 6th of April 2023, the UK, and your intention is not to have a property in the UK, it's still possible for you to dispose of your UK property even after you've left and not pay any UK capital gains tax. And if you have locked in a lot of capital gains on that property, you may have bought it 30 years ago and you're sitting, those property prices have maybe tripled or quadrupled and you've got a lot of money locked in your property. Why wouldn't you want to sell it within that window of opportunity of 9 months where you pay no UK capital gains tax? Because remember, capital gains on UK property is is payable in your country of residence in the
Okay.
UK.
Good
So
to know.
when you plan your exit, you should give serious consideration to what date am I exiting the UK, when am I arriving in my new country of residence. Do I want a UK base? And if I do, is it the main residence or could I just have a bolt hole?
Mhm.
If I want to dispose of my UK main residence, how long do I have to dispose of that property? So if we are sitting here in January 2023, this individual, John Smith, is planning to exit the UK on the 6th of April. He's got 9 months from the 6th of April, which would take us to, I don't know, 6th of January or whatever, 2024, in which to sell the property with no capital gains. So you can't just look, of course, most of your energy should flow to where you are going to, right? Because that's where as Matt alluded to, most of your income streams are taxed, but there's still, little tricks here and there where you can save tax in the UK as you exit. And that's why arranging an orderly exit and having someone that understands, the tax regimes in the UK, as well as your new country of residence in the Iberia, whether that's Spain, Portugal, or Gibraltar, is crucial.
Yep, good to know. Thank you for that, Paul. Questions come in hastily written, I think, because this particular viewer isn't able to join us live today. You can join us live every Wednesday morning, but we do love to get the questions in as well, and they will watch this on replay, they say. I believe if you leave the UK and become a Portuguese-Spanish resident before your pension has matured, you're unable to purchase a UK-based annuity. What are the other options? SIPs, offshore pension scheme, etc. What would you say to that?
So it's I think for that one, Carl, it's it's there are options, and it really depends on the individual circumstances. But yeah, there are international SIPs that are available that may be more suitable for somebody in this situation.
Okay.
You have the offshore schemes, which is the CUROPS. So for someone based in Portugal, that would be based in Malta, and it's a good question, because regardless of what someone is intended to do with their pension, they need to explore all the different options to see which is best for them. Because a QOPS, for example, offers quite a few tax benefits that we've covered before, maybe here in our webinars, which we'll do in future, for the person in receipt of that. So that's something that should always be investigated to see if it's suitable for that individual. So yeah, there are plenty of options, and generally just retaining your pension in the UK scheme is not the most tax efficient way of dealing with that.
Okay.
So that's what they should look at.
Excellent stuff. Okay, and a couple of other questions, but these may well be rolled forward to next week, because they're asking about a particular investment fund, and they're also asking about security, safety of investment, and which I think we should address perhaps next week. And I think it's time to look at the Portuguese and Spanish bonds next week. That's the theme of the show, as I understand it.
Well, it's our special offer, Carl, next week. We teased with it last week, and this is Paul's brainchild. Is that the right term? But it's an incredible offer, and
Right, okay.
for people living in Spain and Portugal, are those people moving, and it's unbeatable in the market. So yeah, we've got details on that next week that people might find very interesting.
Perfect. Okay, so we'll talk more specifically about in the investment vehicles of that kind and that special offer, and of course we'll take into that, as well as the upside and advantages, the security and safety aspects of the products as well. Final thoughts then, gentlemen, today, as we make our way into the Iberian sunshine. Although maybe that's not the case for you. Noses to the grindstone, I suspect, in anticipation of the Portuguese and Spanish bonds next week. Last word from you, Matt.
Just to kind of repeat, really. Look, we always say, but plan in advance. The sooner the better. And we forget now that there is time to do this, because as Brits, and to kind of go back to the Brexit theme we had earlier, visas are a thing that unless you have access to an EU passport, somehow visas are required. So there is a planning process. So integrate it all together, understand, and we can give advice on that as well. So planning, align yourself with somebody who understands the taxation in your country of resident and your new country of resident. Do things properly. That's all we ask for people.
Cheers, Matt. Over to you, Paul.
Just to reach out. We're here to help.
Yeah.
We think we can embed a lot of value. We care passionately about serving the British expat community in the Iberian Peninsula. Sometimes, a second opinion. Don't be confused by what you hear in the pub. Don't go with the first person you speak to. Make sure that they've got the right credentials and that they're a reputable firm and they really care about you. And yeah, reach out, because we don't bite, and we are, as you can see, normal blokes. We are the normal ones. Yeah, we're not the special ones. We are the normal ones.
Very good.
Um,
Reach out via fiduciarywealth.gi.
yeah, so we are human beings, and we're always happy to engage and help if we can.
Great note to finish on. We'll see you next week with that bond offer then, that special offer. They may be normal blokes, but they got a special offer for you next week. Have a great day. Have a great week.
Thank you.
Keep those questions coming in for us to take care of on the podcast here, the Money and Finance for Expats podcast. Thank you for listening and watching, and we'll see you next week. Bye for now.